Online, sorry, you are muted. Now we are okay. Oh, so online, I was saying there was a power issue. So the generator connected, so we had to connect back. Similarly, when the power is back, you'll be disconnected again because the power must be back. So we continue from where we left. So probability of default is 0.05, 0.2, 0.5. So what you do for me, for each, you multiply, you bring them there. Then what I want is the total. So take this and this there, then add the 3, give me the total. Chop, chop. Hmm? 55, 50. So 55, 50. Was there expected credit loss in the trial balance? Can you check? Because if there is, you only consider the increase or decrease. But now that there was nothing, the whole amount is considered to be the increase. So the examiner said this one we take to administrative. So go there and say expected credit loss. Expected credit loss in the administrative 5550. That note is gone. Let's go to note 5. Let's go to note 5. Included in other operating expenses is a payment of 10 million made on 30th September 2021. This is the annual lease rental of this year. Although the company is treating the lease as an operating lease, computer and network equipment being paid in arrears. The lease is for 5 years, beginning. Beginning, I don't know which one. The implicit interest rate is 10%. Any depreciation expense is classified as what? Administrative. So that is a lease. So what they are saying, they had a lease property. Then the amount they are paying for rentals is what they were doing what? Well, one expense. Now under administrative. That is very wrong. When you have a lease is a topic we covered here. When you have a lease, rental should not be part of the expenses. When you pay rent, rent caters for 2 items, the principal and interest. So what you need to expense is the interest, not the principal amount. So what we do in regards to that lease, let's do what is called lease amortization so that we can be able to get that interest part. So, but there is something I'm likely to forget. What did I do before I forget it? The lease is being depreciated. So right here, depreciation on leased assets. On leased assets. Every year, they are paying how much? They are saying they are paying how much per annum? They are paying 10. So look. And this year is, they have said it's the first what? The first year. And the lease is going for how many years? 5 years. It means they're supposed to pay a total of 50. So it means the value of the leased asset is how much? 50. So depreciation will be 50 divided by how many years? 5 years. So I know someone is going to ask me again, How did you get 50? They are saying they are paying 10 every year, 10 every year. And this is year 1. And it is going for how many years? 5. So we can reason out very fast. The value of the lease is 50. So that is 10,000. Depreciation was being classified. What was it? Admin, eh? Yes. So they will say we take it to admin. That is 10. They have said we take it to administrative. That is 10. Then the problem we are having with that is that 10 they are paying, they are expensed. That is very wrong. When you go back to administrative, what you should expense is the interest, lease interest. The principal part should not be expensed. Loan, but the lease is treated as a loan. Eh? When you take a loan, if you do loan repayment, that is not an expense. What should be expense on the loan is the what? The interest. So let's do what is called lease amortization. Then we see what happens. So say here, outside there. Lease amortization schedule. So right here, balance brought down, finance cost. They have said the implicit rate was 10%. Then you say principal paid. Then balance carried down. Like that. So this is year 1. I'm going to be interested in year 1, but for this, just go for 2 years. Just go up to year 2. That's the idea. So year 1, year 2. The balance brought down is the value of the lease, which we have determined to be how much? 50. Which we have determined to be 50. Finance cost will be 10% of the amount, which is 5. So, rentals paid. Eh? Yes, fix there. Rentals paid. Rental paid. Then principal. Principal paid. Just fix that one there. I forgot. We should have the column for rental and principal. Because we are not there. So rental paid. They said they are paying how much per year? They are paying 10. So of the 10, when you pay 10, kwanza unakatwa nini? Interest. You know, finance cost is the interest. So of 10, 5 goes to interest. So it means the principal out of the 50, what has been paid is how much? 25. You know, the principal amount is 50. Of the 50, you are charged interest of 5. Then you are paying 10. So this 10, 5 will pay interest. So out of the principal amount, the amount paid is how much? 5. So the outstanding balance will be 50, which was the principal, minus the principal paid of how much? 5. So outstanding is how much? 45. Let's go to year 2. Year 2 is 45. 10% of this is 45. Rental, they are paying 10. So take 10 minus 45 to get the principal paid. Principal paid is 55. So take 45 minus 55 to get the outstanding balance. So outstanding is how much? I'm being told by Carol and 39,500. Bus. So how is this useful? What they did, they expense the whole amount they have paid. At least the principal is not an expense, you only loan. So what you expense is what? The interest. Finance cost is the interest. So that is what you charge, P&L. Then in the balance sheet, at the end of year 1, what was outstanding is how much? 45. Out of 45, what will be paid in the next 1 year is a current liability. So of the principal, what will be paid in the next 1 year is how much? 55. So this is a current liability. What will remain unpaid in the next 1 year is non-current what? Non-current liability. That is how we do this. So you will remind me in the balance sheet, what is payable out of 45, what is payable in the next 1 year? So next 1 year, unajua tukifunga year 1, next 1 year is year 2. So in year 2, this one will be paid as part of principal. And what will remain out of 45 is how much? 39. So 39 is an non-current liability. It will be long term. This is short term. But in the P&L, we are supposed to recognize a finance cost of how much? 5. So go to the allocation schedule. You say interest on lease. Interest on lease, take it to finance cost. That is 5. All right, that is done. Let's go to note number 6. Let's go to note 6. I don't know why my mic keeps on going and coming back. I don't know what is the issue. So online, I don't know why the mic is misbehaving, but I hope we are good. We are in note 6, where we have checked the redundancy. The redundancy. I hope we are good. Let's go to note number 7. I'll be checking this thing frequently. Note number 7, after computing the cost of sales we have, the management was made aware about an error with the inventory module in the accounting software, which understated the opening inventory by 10 million and the closing inventory by 5 million. The amounts are considered material on the company's what? Policy. So opening stock was understated by 10. Closing was understated by 15. By 15. So about to find practical, I see what happens. About to find practically. How do you get cost of sales? Opening plus purchases minus closing. Let's assume this. Let's assume opening inventory was 800, was 80, purchases was 90, closing was 70. Just assuming. So if that is the case, what is the cost of sales? 100. Eh? The cost of sales is 100. So if we apply what they have said, understate with those values. I want to see what is happening to cost of sales, so that I should know whether to add or to. So the understated opening by 10. So understate also by 10. To how much? 70. Purchases remains constant. Then closing was understated by how much? Understate this by 15, you get 55. Sure. Purchases remains constant. What will be the cost of sales? We are just testing to say cost of sales will be 105. So cost of sales will be 105. So what is happening? That when you under, you are overstating. Sure. So the cost of sales is going up. So whatever happened there overstated the cost of what? Sales. By when it was 10-15. So that difference of 5. It is overstated by how much? 5. Have you understood what I'm doing? We have assumed these figures. Then now we are trying to do what they are saying. Yeah? We want to know whether they overstated or they understated the cost of sales. Understate this by 10, 70. This one remains constant. Understate this by 15. Cost of sales comes to 105. So it means the cost of sales there was also overstated by how much? It was overstated by 5. So come here and say inventory. Grace, no means what? Grace, I can see a no. No means. And wait, where's the R? I always know your R. Yeah. Oh, umeelewa, sawa. So it means our overall cost of sales was also under or overstated by how much? 5. So you come here and say inventory adjustment. Take 15 minus what? 10. So it was overstated by 5. You subtract. It was overstated by 5. Number 8. Number 8. The par value of the loan stock will be settled in 2025. The effective interest rate is 10%, and the company has classified the loan stock as. So to set out your 10%. Note 9. The corporate tax for the year is 35. Current tax 35. Good. Continue. The taxable temporary differences as at 30th September 2021 are given as follows. So ukisikia temporary deferred tax, so hapo chini chora deferred tax account. Deferred tax account. You will check the balance at the beginning. You will see it in the trial balance. Opening deferred tax was how much? 12,800. Balance carried down. For deferred tax, they are saying totally 47 plus 3, 50. So take 30% of the 50. That is 15. That is 15. However, check out the arranged that note 9. The taxable temporary differences are given below. For adjustment to P&L, 47. For adjustment in revaluation, 3. So inside this 50, there is inside the 50 there is 3, and that 3 has been taxed. Then you go to a 15. If you can recall the topic of deferred tax on revaluation should not go to P&L. Revaluation is other what? Other comprehensive. So if you want to know the deferred tax which will go to the balance sheet, the income statement, sorry, in the profit account, then you eliminate. We have said, how have we arrived at 50? Check how we are getting 50. For adjustment in profit account is 47. For adjustment in revaluation, 3. So 50 is the 47 plus what? 3, which we have taxed, and ideally you should tax, is 15. But now, you know the increase is what should go to P&L, from 12 to what? 15. The problem we have is that this 15, there is deferred tax as a result of revaluation. Of how much? 3. So you need to subtract, because revaluation should not go to profit account. So you come and eliminate it by crediting the account. You say revaluation, 30% of the 3, which is here. The 3 is in the 50, but you credit to eliminate of 3. 30% of 3 should be how much? Should be 900. So the increase P&L, the balancing figure, is what we'll take now to. Revaluation should not go to P&L, so you have to eliminate. So how much? Mm-hmm. 1300. So that is the increase which you take there. So you say increase in deferred tax. We are done with the notes. Can you add for me all this? Add for me vertically. That might not have a lot of story. You should be having the figures. So you will confirm 473, 250, 190, 550, 2800, 39.7, 103, 550, 10. 10. Are you making it? Confirmed, eh? Yes. Which other working do you want us to do? Evaluation. Let's check evaluation. Let's check evaluation. Then PPE. So what does evaluation at least? No. There is no need. Let's not bring problems where there is no problem. Check note 1. We have a lot of problems. We cannot import others. Check note 1. So they just said land was revalued by 3. So that is the revaluation. So what do we want even to do, Akuna? That is the revaluation gain. So revaluation gain is not 3. Ignore. Let's do PPE. Let us do PPE. So PPE will be, let's start with that land. Let's start with the land. So land, what was the cost in the trial balance? How much is this? 140 plus 3, eh? So the revaluation is 3. So you take 140 plus 3. You get 143. Followed by buildings. So buildings, you will take, the cost is 300 minus accumulated depreciation. So, nani aliuliza hiyo swali? I don't know. Alima hiyo mwenyepeana gani? So 300 minus 48,200 minus this year. Check your allocation schedule. What did you charge for buildings? 6,000. So give me that answer. Hmm? 245, 800. Then we have furniture and what? Equipment, 131, 250 minus accumulated 87 minus this year 26 to 50. What is going on online? Naongea when we talk at 1945. Cost of sales is not correct. Cost of sales. When am I going up? 180. Well, year 5, I hope umetoa because it was overstated. Wewe umeandika kitu baya na is there a group kuna group wamecopy? Cost of sales is how much? What? 180. Like that. Caleb, why means what? The stock, we did an experiment. It was overstating the cost of sales. So we had to subtract. So to the test pale tunapata understate naenda juu. When you understate opening, you understate closing, we tested and we saw the cost of sales was going up by 5. So you subtract because it is overstating. Eh? Alright. Back here, furniture and equipment, how much? Yes, it is, Alima, it is 185.50. You are saying? 17? Like that. Another one, motor vehicle. Motor vehicle was how much? 120. Accumulated was 22. This year, 30. Total. Motor vehicle total 30. Kama umejua ile group ya subtraction au bracket. Kama ni bracket. How much is this? 16,000. 16,000. Then there was the list assets. The cost was 50. Depreciation this year we charged how much? 10. We got 50 over 5 years. So here is remaining how much? 40. So get for me that value. How much? 514. We are done. Nani akona swali? We want to 12:45. We want to do P&L. I want us to do P&L. Just keep it to so P&L. So right, if you don't have question, I take a denial. Vista. We are only doing P&L, then those two will complete in the next. So They are calling themselves who? Vista. We kick off. Revenue. Revenue, working one. Cost of sales. Or gross profit. How much is that? 92,700. Good. Other income. Other income. 28. Distribution. 39. Wala weki bracket. Takuchukulia. Ama wanaweka bracket alafu wanachukua. Admin. Ni mbona unaweza kuwa unajua? 550. Finance cost. 10. Give me profit before what? What are the profit before tax? $142. 50. PQ 142 to 50. Income tax 36 300. Okay, PAT will be 105 950. 105 950. Other comprehensive income, there is revaluation what? Of how much? 3,000. So total comprehensive income 108. Eight minutes, we can do statement of changes in equity. The second one. You have a question? Akina chukua uliona hiyo kitu sasa za hivi ndio nataka kuuliza kiwa mkuu safari ya mbali. Note 9. Yes. So tume subtract ingine. So tulikalkulate ikakuja 15 yote. So tukatoa 9. So the difference yote imeenda kwa kia. Sindio? Sawa. I want us to do the statement of changes in equity. So statement of changes in equity are ordinary share capital. So ordinary share capital. Was there share premium? That question. Share premium. There is revaluation. Revaluation what? Reserve. There is retained what? Retained earnings. These are two ziko hapo. Hata mostly ni hizo. Then you will give us the total. Have that. So right for me, balance brought down. Balance brought, sorry. Balance brought down. Pick for me those figures the way they are appearing there. Welcome back at total. Mtu akienda Uganda pia anasema ni majuu. Uganda ni majuu. Hata walimu jina ya majuu. Majuu is very serious, right? So balance brought down ordinary. 200 share premium. 119,400 revaluation. 21. Okay. Retained earnings. 130. Total. Oh. For 70. Then you check anything affecting these items one by one. Ordinary note, there was no note of shares. Kama kuna zile kama bonus, top up, there was no note. Even this one there is nothing, but there was a revaluation what gain. So say here revaluation gain. There was a gain of how much? 3,000. But I have a problem with that 3,000. Read note number. Read note number which one? What? Note 9. The temporary differences for adjustment in revaluation. Are you seeing the 3? You're 3. So of the 3, come here and say to D tax, to deferred tax, 30%. 30% of that 3 will go to deferred tax. So let's go punguze hii with the 900. Just a minute. We proceed to evaluation done. Retained earnings. Give me PAT, profit after tax for the year. How much is the profit after tax? Vale. 105. Dividends. Did they pay dividends? Was there dividends paid? Yes, how much? Eh? 8,000. Only for dividends. Fisher. So that's how we prepare statement of changes in equity. Balance carried down. Get those figures. 200, 119, 400. Those others you can get at your free time. So next we will do the balance sheets. Next. So we will finish those others, then we meet in the next class. We do the balance sheet, then I introduce another topic. The most important thing, mnapata concept ya published. Yes, hiyo ndio kitu muhimu. Ukiona published, kwa nini nini? Mpaka unaangalia tena, unaangalia kwa junior far ama ni advanced. So that's the most important thing. So thank you. Syllabus tutamaliza mapema, nimesha project. But nitawaita Sunday morning for 4 hours. How about your 4 hours if I can? So thank you. When I log out, I want to extract all these videos.